Hello, this is Books of the Stock Market. How's everyone doing? As for me, I'm doing pretty well. Today is January 1st and 2020 seemed to pass pretty fast for me. It seems like as you get older, time just rushes by faster. Since it is January 1st, I've made some New Year's resolutions, and the one that I want to really not break is limiting myself to 1 bag of chips per week. I don't drink a lot nor smoke, and I exercise 6 times a week, but I consume a lot of processed foods. I usually eat around 2 to 3 bags of chips per week, so limiting it down to 1 a week shouldn't be hard. With that self-reflection out of the way, let's talk about today's topic. Today we'll be going over the second part of moving averages. This video will cover adaptive moving averages, moving average envelopes, Bollinger Bands, and the 4-week rule. We will then do some technical analysis on Ethereum using the tools that we have covered in the video, so make sure you stay tuned till the end. Let's first go over adaptive moving averages. The adaptive moving average was developed by Perry Kaufman, and it was made to adjust to the volatility of the market. For instance, different lengths of moving averages should be used when trading in a volatile market versus when trading in a sideways trading market. Therefore, Perry Kaufman created this moving average where, if the market is moving sideways, the adaptive moving average moves more slowly like a long time period moving average. On the other hand, if the market is trending up or down, the adaptive moving average moves more like a short time period moving average so that it can adapt to the volatility. Here, we have Ethereum on the 1-week time frame. We have the Kaufman's adaptive moving average shown as well. When the line is red, it represents a bearish situation. When the line turns green, it represents a bullish situation. Like the other moving averages covered in the previous video, they're all very similar, but just calculate the moving average a bit differently. Now let's talk about what a moving average envelope is. A moving average envelope is used to determine when the market is overextended in either direction. The most common moving average envelope is the 3% envelope. This means that the area 3% above and below the moving average will be shaded. For instance, if price reaches the upper portions of the 3% region, then the market is considered overextended, and most likely there will be a decrease in price. Likewise, if price reaches the lower portions of the 3% region, then the market is considered overextended, and most likely there will be a rise in price. Like a moving average envelope can be adapted for longer and shorter term trades. For instance, a 5% envelope will be used for a longer term trade, while a 1% envelope will be used for a shorter term trade. Here we see SPY on the 1-day time frame. I also put a 3% envelope with a 20-day moving average represented by the orange line. Here we see the times when price moved above the 3% envelope, and every time price moved above the 3% envelope, price will contract back into the envelope. The green circles represents the times when the price moved below the 3% envelope. Likewise, price will shortly move upwards into the envelope. However, it is important to note that a price can be extended for a long period of time. For instance, here we see price was trading above the envelope for almost a month. Therefore, you probably shouldn't add or reduce your positions just because it went below or above the envelope. A safer bet would be to look at multiple indicators to see if price is going to be overextended for a long or short period of time. We will now move on to Bollinger Bands, which is pretty similar to a moving average envelope. Bollinger Bands shade the area 2 standard deviations above and below the 20-day moving average. Similarly, price is overextended when price touches the upper and lower bands. Therefore, Bollinger Bands are mostly used to set up a price target. Let's now discuss how to read a Bollinger Band. Unlike a moving average envelope, Bollinger Bands expand and contract based on the 20 days volatility. They alternate between a state of contraction and expansion, and a state of contraction means that the Bollinger Bands are really close together, so the Bollinger Band width is very small. On the other hand, a state of expansion is when Bollinger Bands are really far apart, so the Bollinger Band width is very big. Furthermore, if the bands are unusually far apart or the Bollinger Band width is big, then the current trend may end soon as the market is very overextended. On the other hand, if the bands are unusually close together or the Bollinger Band width is very small, a breakout in either direction may occur. Here we have Litecoin, and I have the Bollinger Bands shown as well. We see that in the purple box, price has been consolidating for a long period of time. Since it was in a period of consolidation, there was low volatility. This means that the Bollinger Band width is very small. It became really narrow around this area, and all we know is that price was about to break out in either direction. Price decided to break out upwards, and we see that the Bollinger Band expand. It once again contracted, and price consolidated for a period of time. Remember, when the Bollinger Band width narrows, the price can break out in either direction. In this case, price decided to break downwards. Once again, a consolidation occurred, and price decided to break out upwards. This last purple square shows that there was a bit of Bollinger Band width contraction, and it produced another move upwards. Towards the end of this green box, you can see that price is currently consolidating, and this causes a lower Bollinger Band line to move upwards toward the upper Bollinger Band line, and this produces a more narrow Bollinger Band width. As with all tools used in the stock market, there are benefits and disadvantages to moving averages. The main advantage that moving averages have is that it follows one of the oldest sayings in trading: trade in the direction of the trend. Therefore, in a trending market, moving averages can be really helpful. On the other hand, the major drawback of a moving average is that they perform very poorly when the market gets choppy or when the market starts trading sideways. Statistically, the market is consolidating over 1/3 of the time, so using moving averages as your sole indicator would be pretty bad. Now that we have covered the different moving averages, let's look at the 4-week rule. The 4-week rule has many benefits of the moving average, but it is way simpler to use. The 4-week rule states that you should cover your short positions and buy longs when the price exceeds the highs of the past 4 weeks. On the other hand, you should liquidate your long positions and sell short whenever the price falls below the lows of the past 4 weeks. Like with many financial indicators, the 4-week rule can be adapted. Shortening or lengthening the time periods allow you to control the sensitivity. For instance, if you shorten the period from 4 weeks to 2 weeks, it produces a more sensitive buy or sell signal. On the other hand, if you lengthen the time period from 4 weeks to 8 weeks, you have a less sensitive buy or sell signal. Now, let's discuss how to use the 4-week rule in conjunction with longer or shorter time frames. The 4-week rule should be used to enter the position, as anything under 4 weeks may produce false signals. Additionally, the 2-week rule can be used for exit strategies so that you can have a tighter stop loss, as the 2-week rule is more sensitive. To illustrate, you'll first enter a position with the 4-week rule, so when the price goes above the 4-week high, you would add to your position. The second step is to create a stop loss using the 2-week rule, and you would put your stop loss at the 2 weeks low. Here we have Ethereum on the 1-week time frame. These are the 4 last candles, and let's now apply the 4-week rule. This is the zoomed in version of the 4 candles, and we see that the high was around $757.24. This means that we should wait until Ethereum rises above $757.24. If we were going to use the 4-week rule to also do our stop loss, we should set it to the low of the 4-week period, which was $530.59. This is the same graph as before, but let's use the 2-week rule so that we can have a tight stop loss so that we're safe from the sudden drops that happen often in cryptocurrency. Here we see the 2-week rule will have us put the stop loss at $547.53 instead of $530.59. As promised, let's do some technical analysis on Ethereum. With Bitcoin rising to all-time highs every day, many people are wondering when alt season is coming. Although Ethereum is not really considered an altcoin, it can be said that it has not been making all-time highs like Bitcoin. As of recording this video, we see that price broke an important horizontal trend line. This horizontal trend line had a level of $745.23, however, price failed to hold it. I've already explained how I mapped out my horizontal lines in a previous video, so if you want to know how I got this trend line, look in the comment section below or click on the small I button in the top right corner. If we zoom into this area, we see why Ethereum couldn't hold the horizontal line as support. We see that the price was a bit overextended in this area. Since price was above the upper Bollinger Band, price had to retract, causing the horizontal level to not hold. We can also see that the Bollinger Bands so far were widening quite a bit, meaning that there might be some consolidation in the near future. However, it is important to know that especially when dealing with cryptocurrencies, price can break out for long periods of time. For instance, here we see after the consolidation, price was trending upwards for about a month before consolidating again. Well, that's it for this video. I hope everyone learned as much as I did reading a book, as that's the whole point of this channel. In this video, I finished talking about moving averages. As discussed in the past two videos, moving averages only work well in a trending market. So what do we do if the market trends sideways? The next video will discuss oscillators and how to use them in a trendless environment. So if you don't want to miss out on these topics, please subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I will try my best to answer all the questions. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.